Hey all, we're talking about cash flow budgeting today. I've got a little bit of a presentation here ready for you, and we've talked about balance sheets and income statements and that sort of thing. The income statement, P&L statement, of course, is really important in the fact that it shows your profitability. In order to be accurate, we've got to actually make some adjustments for that so that it's done on an accrual basis, especially those of us in agriculture that are interested in running on a cash basis. But and then the balance sheet, of course, we're going to show in the end what our equity is, whether we have some liquidity or solvency within our business, whether we can operate in the short term and the long term, that sort of thing. But the cash flow statement is something that is really important. Most people use this as a projection and for planning, but we can also look at it in real time, especially if we already have a projected statement. We can compare how our budget is to our real-time situation. So it's something that's worthy of comparing. I always tell people, until you start budgeting, it just takes practice. And in order for us to hit the target of what we've projected as far as a budget, then you just have to do it. You have to get better at it. You got to flex that muscle, that sort of thing. So don't get discouraged if you're way off in the beginning. You're on your way if you just put it down on paper. My old dad, and I'm sure some of yours did too, or mothers as well, because they were usually the record keepers in many operations, but said if it doesn't work out on paper, it certainly is not going to work out in the real world. So I think as I've been in business so long now, I know that is absolute truth. I was a little bit of a skeptic when I first heard that the first couple of times anyway. But as you try it a little bit, you're going to be just fine. Okay, well, these are just some of the reasons that you would use or put together a cash flow, but we'll get right into some of the things that we want you to be able to do, or identify the cash flow as a budgeting decision making and for analysis of your business. The big part of it is that you're either going to have surpluses or you're going to have deficits. Surpluses are pretty easy to deal with. Especially if you put them aside and use them for times when you actually need them. And that's what we're usually faced with in an agricultural sense. When we just sell our product once or twice a year, then we're faced with, cash going out of the business for the rest of the time. And so we've got to build up some reserves in our cash flow through the business in order to remain intact as a business. So we can use that and analyze when these times of surplus are and when the times of deficits are, so we can plan for them. It will enable us to understand the structure and components of the cash flow. And as I've mentioned, we have two major ones. We either got cash coming in, that's when we sell things, and we have cash going out when we actually purchase things. Okay, so it's not going to be like an income statement where we have non-cash expenses, we've got inventory adjustments and stuff like that. It's going to be actual cash coming in or out of the business. We'll take you through the action and illustrate how the cash flow budget works. And then point out some of the similarities that we have between the cash flow and the income statement, of course. Okay, and discuss some of the advantages and disadvantages to some of the potential uses of the cash flow. Okay, cash flow, what is it? Well, first of all, it's the financial analysis tool with applications both forward planning and ongoing analysis, real time, what I was talking about earlier, in your business. Okay, the number one reason that businesses fail is because of the lack of capital, or we can actually say because of cash flow. Deficits, as we indicated before, are the reasons why you would shut your shop. and the inability to capitalize any of your business. Cash flow budget is the summary of all the cash inflows and outflows for a business over a given time. Most of the time, our production season is 12 months. And we're going to look at several different kinds of cash flows in this discussion, but I like to look at it at least on a monthly basis. If you're in the retail business down here on Main Street, you might even look at it on a weekly basis and want to take a look at it and where your surpluses and deficits are in that relationship. I think it'd be somewhat of an overkill in most operations that are agricultural in basis. So let's take a look at this kind of thing. This just shows a funnel from the top. Our inflows are coming into the business. What I like to think about, if we only run out of one checking account, if you look at your statement for that checking account, that's your cash flow, actually, just in a statement. We're just going to present it a little bit more readable in a cash flow statement. But anyway, we'll have the cash inflows. Those would be your sales and new loans. So cash comes in that way. We might sell some capital items like a tractor. We might sell some land. We might sell a little this and a little of that in order to make up the full cash inflows to the business. And then we have things that are going out. And those are the cash outflows. So those would be your operating expenses, of course, whatever it takes to run the business. We are paying debt payments. We've got interest payments on loans. We've got taxes and etc. Anything that goes out as far as cash goes would be considered part of the outflows. So the major components of the inflows or the cash that comes into the business would be, first of all, we're going to start with something. Hopefully it's not a deficit. I know my bank account has looked like this at times. We used to be able to get away with that, but with instantaneous banking anymore, we can't actually count on the check getting to the bank, being cashed, and the several days that we would have had to take advantage of that. Anymore, we pretty much have to figure out what we have in there and go with that. So we would have an account balance that comes into the beginning of the month or the period that we're talking about. In that period, or in that month, we would have product sales or not, depending on whether it's a month in which we market some of the things that we're in business to sell. And that could be calves, it could be lambs, it could be cold cows, it could be meat bulls, anything that you sell as a byproduct of your business. The second thing that we might have for cash sales would be capital sales. Again, these would be things like land, tractors, vehicles, might be land. I said that, didn't I? But anything that we actually use, those items or assets that we use to make income through the business. Though if we sell some of that, then those would be actually part of our inflows. Non-business cash flow receipts we used to think about. I've kind of, at least in my discussions, I hate for people to actually include this in here, although I know it has for me, and it probably will for you if you've got a spouse or if you work off the farm or ranch, then you may actually be bringing cash in. But we can show that as a loan or stock or something like that as well. So, but it still would be included as non-business cash receipts. That would be the more typical ones if you had to actually keep your business going. And many years where we had to do that as well. So don't think you're alone if you're the only one. We may borrow actually from a lender for capital items or operating loans. Or for anything else that we might use in the business, and those would be an actual cash inflow. Okay, here's a very, very simplified cash flow, and it shows what I like about it. It shows in a real simplified fashion how the beginning cash starts, and then we in this case have farm product sales of 2,000. We've got total inflow of 3,000, counting the beginning cash. And then we have outflows of farm operating expenses, 3,500, capital purchases of 10,000, miscellaneous expenses of 500, cash outflow is 1,400. As you can see, we can very easily find out that we're in a complete deficit. This is not something that is can be. We can't continue down this road for very long, and we can't get out of the month without doing something. That we're going to have to actually borrow some funds. In this case, we borrowed $11,500 so that we wouldn't actually drain our account completely out. And if you'll notice, in the next cash flow, we actually force it to actually have more than that. So you wouldn't ever want to get your cash below zero, because then the bank starts sending you some bills for about $45 every time that you have a non-sufficient fund check. So anyway, at the end of this period, we have a $500 type ending cash, debt outstanding of $11,500. Your ending cash goes up to the top of the next period. That could be the next month, and becomes your beginning cash balance. You start over again, selling some items in. So your total cash inflow is 18,000. That in this particular period, you still have some expenses during that time, and so your total cash outflow is 2,000. Your cash balance is 16,000. So we would, in this case, pay back some of that loan that we took out the period before, and that would give us an ending cash balance of $4,300. Okay, so that's in a real simplified type of a cash flow. That's how that works. Many people, and your banker might actually use this in order to project and keep track of your operating note that you need during times of deficit. That's why we would actually have an operating loan for our business. And I'm not going to get into it too much. We've already taken you through some debt lessons, and but some of you are going to operate with some debt, so I'd like you to understand how you can do it. I'm a very big proponent of incrementally growing your business and operating from your own cash. Okay? Sometimes things don't work out the way you think they ought to. Sometimes you have other people and other influences, and it's just you're not making all the decisions. So there are ways, and this cash flow actually, if it works out, is one way to actually analyze and figure out how you can do that with a little bit of debt. I'm not saying it's a great thing. Best case scenario is that we don't have any debt at all. The cash outflows are the operating expenses that we have during the period that we're studying, and also capital expenses those would be purchases like tractors and vehicles and equipment and those kinds of things. We may have some non-business type expenses too. What in the past, what we generally did was the wages or the draw that the business would give you would be considered non-business. I've always been a proponent that you actually pay yourself in one fashion or not. You may have to consult with an accountant in order to do this, but anyway, there's a couple of ways you can do it. You can do it in a draw fashion, or you can pay yourself wages. But again, first thing to do probably before you start doing that is consult an accountant to see which is the best way or practice for you to do in that order. Principal payments could be a major component of this cash outflows. So don't forget those. Include the interest. I usually use a separate line item for them so that I can actually project those kinds of operating expenses too. So those would be huge in most cash flows. And here's that one here. Now I don't want to cover this too much, other than we may give you some homework on it. But the cash flow statement is one that my colleague and I have developed, and we used it in a farm management contest actually. But you can use your own numbers, plug them in the non-formula type cells, and if you have any trouble with it, you can always actually give me a call. So here it's got income statement, balance sheet, cash flow, the whole works with it. But here's the cash flow, and you can see that it's quite extensive. But you can simplify it if your operation is a little bit different than this and is quite a bit more simple. I like to actually have things set out. It's a little bit on steroids, what I call, but on the same token, at least I can analyze things. We've got several different enterprises that we have actually influencing this cash flow. From a cattle enterprise, we have outfitting, and we can simplify these and put them in one line item if we'd like to do that. One of the things that we've actually set in this particular cash flow is that the business will not have an account or checking account that falls below $100,000. So we're not going to get caught with too much of a deficit in that regard. So, and you can look at it from it's a 12-month cash flow, and if you only have annual payments, we've got some different kind of payment schedules for different tractors and things like that that are influencing this cash flow. Land payments, you can set them up on a monthly basis or an annual basis, semi-annual basis, or anything like that as well. So if you need to change it at all, let me know. Anyway, this kind of is one way to take a look at it. And this one is set up primarily to let us know when we do have those deficits and surpluses, and when we will actually have to go to the bank and pick up the phone and say, I need a little injection of cash so that I can get through the month, or I'm gonna go ahead and transfer some money over to my loan account so that I can pay it off and save myself some interest. So have fun with that. I know it's a big one. You can do anything you want with it as far as that goes. So, as I explained, we can use it in order to figure out how we're going to borrow and how we're going to repay. May suggest the rearrangement of purchase and borrowing to minimize that debt. We don't want to have that. If we actually use debt, we don't want to have it overhanging the business for any longer than we need it, because we'll just be paying more interest. And of course, that's going to take a bite out of our profits if we're in the black, or increase the amount of losses that we're experiencing within our business. Not a good thing in either way. Well, we would also use this cash flow to share with other experts so that they can spot our weaknesses or strengths if we don't have a way to get out of where we're at. And of course, the cash flow is a great instrument in order to plan ahead with. Tax planning is another place that we would take a look at it. Might show where we're going to have a larger influence, especially if we report our income on a cash basis to the IRS, that we could actually pull some figures from that so we could do some tax planning ahead of time. And of course, as we've been talking all along, the big impact for planning is that it's certainly going to give us some idea of an imbalance in cash in current and long-term debt. So some great things that we can actually figure out. One question I have for you is, does a positive cash flow actually mean a profit? I'd like to have you contemplate that. I might even ask you within the context of our homework this week. So anyway, um, let's go on and talk about some other things. So I think we're about ready to you've probably listened to me long enough as far as that goes. Just to summarize what this cash flow statement uh, can do. Um, Most lenders, in fact, I actually had a young man that was wanting to buy part of our business, and I told him, I said, well, I'm going to have to see a cash flow from you so that I can figure out whether or not you could afford it. And and your lender, whoever they might be, whether it's an individual type of investment banker or it's the local bank or any of those, should ask you for a cash flow so that you can kind of plan these things out and see whether or not what's your ability to repay. That would be what they were interested in. You certainly wouldn't want to enter into a business type of agreement where it would be just doomed to failure just because you couldn't repay it. It might even be profitable, but we may not actually have the cash coming in when you needed to make the payments. So it's a great, great type of a planning instrument. So both business and in a family rent situation, in particular, we can add some personal cash that comes in and out of the business, so it's actually included if that's what you're doing, and which is very typical actually. So don't think you're different just because that happens. Um, and no, one of the things to remember is that if it's a non-cash entry, okay, and those would be the things we talked about in the income statement, like the changes in inventory, the depreciation would be non-cash expense. Those things we do not. If it doesn't actually go into your bank account or come out, then it's actually does not fit on the cash flow statement. Okay, and certainly can show you the borrowing needs, cash shortages, and deficits. So hopefully you learned something on this one. I posted also something about profits at the beginning of this. These are just a representation of some of the podcasts that I listen to on a regular basis. I think it's essential, especially when we operate an isolated business like we do in agriculture. We don't a lot of times have outside influences in a positive way. The internet has changed that for us. We have at our fingertips some just phenomenal talkers, that phenomenal business people. A lot of times they're not the greatest talkers, but they've got a lot to say, and some of them are great communicators too. TED Talks has some great stuff on them. They're all for free. I listen to a lot of the EntreLeadership type podcasts that Dave Ramsey brings into his offices, and then of course there's some really good ones. Andy Stanley does a leadership podcast out of North Carolina that's fantastic. There's just, you can't even count all of them, but they just influence and make the richness of business and kind of just give us a boost every once in a while. If we're out there just doing all the mundane day-to-day tasks, we're up late checking cattle for calving difficulties and stuff like that, it can wear us down. And so sometimes we just need a little shot in the arm. Anyway, that's enough for now. We appreciate you listening, and we'll talk at you later.